Refinancing student loans. You've probably seen the ads, read a few blog posts, and maybe even received a couple of emails from lenders promising better rates and faster payoff. But is refinancing student loans actually worth it? That's the big question, and the answer isn't always so straightforward. In this video, we're going to break down everything you need to know about refinancing student loans. We'll talk about what refinancing is, how it works, the benefits, the risks, and how to know if it's the right move for your financial future. Whether you're dealing with federal loans, private loans, or a combination of both, this guide will help you make an informed decision. Let's start with the basics. What does it mean to refinance your student loans? Refinancing means replacing one or more of your existing student loans with a new loan, typically from a private lender. The new loan comes with a new interest rate, new terms, and potentially a new repayment timeline. The goal? To save money, either by securing a lower interest rate, reducing your monthly payment, or paying off your loans faster. Now, refinancing is not the same as consolidation. Federal consolidation simply combines multiple federal loans into one, with a weighted average interest rate. It doesn't lower your rate, but it can simplify your payments. Refinancing, on the other hand, gives you a brand new loan, usually through a private company, with a different interest rate and term. So, why would someone want to refinance their student loans? There are a few common reasons. First and foremost, to get a lower interest rate. If your credit score has improved since you first borrowed your loans, or if interest rates in the market have dropped, refinancing could offer you a better deal. This could save you thousands of dollars over the life of the loan. Second, some people refinance to lower their monthly payments. By extending the term of the loan, say from 10 to 15 years, you can reduce your monthly payment, which might make it easier to manage your budget. Just keep in mind, a longer term usually means paying more interest overall. Third, refinancing can help you pay off your loans faster. If you're in a better financial position and want to be debt-free sooner, you can refinance to a shorter term with a higher monthly payment and a lower interest rate. Fourth, you might refinance just to simplify things. If you're juggling multiple student loans with different lenders, refinancing can combine them into one easy-to-manage loan with a single monthly payment. And finally, some borrowers refinance to switch loan servicers. If you've had a poor customer service experience or you want better online tools or flexibility, refinancing gives you an opportunity to change lenders. Now, let's talk about the benefits. The biggest advantage of refinancing is the potential for interest savings. Let's say you have $40,000 in student loans at a 7% interest rate. Over a 10-year term, you'd pay around $15,000 in interest. If you refinance that loan to a 4% rate, you could cut your total interest down to around $8,500. That's a savings of over $6,000. Another benefit is lower monthly payments. This can be a lifesaver if your budget is tight, especially if you're transitioning into a new career, starting a family, or just trying to keep up with other financial obligations. Refinancing can also give you flexibility in your loan terms. Most lenders offer terms ranging from 5 to 20 years, so you can choose what works best for your situation. Lower payments now, or faster payoff later. But before you jump in, let's look at the risks, especially if you have federal student loans. When you refinance federal loans with a private lender, you permanently give up all federal protections. That includes income-driven repayment plans, public service loan forgiveness, and federal forbearance and deferment options. You also lose access to special programs that might be offered in times of crisis, like the interest-free pause during the COVID-19 pandemic. That means if you refinance and later face financial hardship, you won't be able to rely on those federal safety nets. For some borrowers, that's a deal breaker. Refinancing also requires a good credit score and stable income. Lenders typically look for a credit score in the mid-600s or higher, along with a low debt-to-income ratio. If you don't qualify on your own, you might need a cosigner, often a parent or spouse. And if you miss payments, both your credit and your cosigner's credit could suffer. Another thing to consider is that refinancing is not free. Some lenders charge application or origination fees, and while most don't have prepayment penalties, it's important to read the fine print. So how do you know if refinancing is right for you? Here are a few signs it might be a good move. You have private loans with high interest rates. Since you're not giving up federal benefits, refinancing private loans is often a smart financial move. Your credit score has improved significantly since you first borrowed. Better credit usually means better rates. You have a steady income and don't foresee any financial hardship in the near future. Stability gives you the confidence to commit to a new repayment plan. You're not relying on forgiveness programs or income-driven repayment. If these aren't part of your strategy, you have more flexibility to refinance. You want to pay off your loans faster and save on interest. A shorter loan term can help you do just that. On the other hand, refinancing might not be right if you're pursuing public service loan forgiveness. Refinancing disqualifies you from the program. You need income-based repayment options. Private lenders don't offer these plans. You're not sure about your future income or job stability. If you might need forbearance or deferment, federal loans offer better protection. You don't qualify for better rates. If your credit score is low or your debt-to-income ratio is high, you might not get a better deal than you already have. So what's the process for refinancing? Start by checking your credit score and reviewing your current loan terms. Then shop around. Use comparison tools or visit individual lenders' websites to see what rates and terms they offer. Most lenders let you pre-qualify with a soft credit check, which won't hurt your credit score. Once you find a lender you like, submit a formal application. You'll need to provide documentation, like pay stubs, tax returns, and loan statements. If approved, the new lender will pay off your existing loans, and you'll start making payments to them under your new terms. If you have a cosigner, ask about cosigner release options. Some lenders offer release after a few years of on-time payments, which can be a big deal for both of you. And finally, stay on top of your payments. Set up autopay if you can. Many lenders offer a rate discount, usually 0.25% for enrolling. So, back to the question, is refinancing student loans worth it? It can be. If you qualify for a lower interest rate, have stable finances, and don't rely on federal loan benefits, refinancing can save you money, simplify your payments, and help you get out of debt faster. But if you're counting on forgiveness, income-based repayment, or federal protections, refinancing might not be in your best interest. The bottom line? Make the decision based on your goals, your finances, and your future plans. And whatever you choose, keep learning, stay proactive, and take control of your student debt with confidence. Thanks for listening. If you found this breakdown helpful, be sure to subscribe for more insights on managing your money and planning your financial future.